Hi, Dave Roscoe here. I get a chuckle from reading the comments. Regardless of the content of the video, I invariably get comments with variations of pi is garbage, pi is going to zero, and pi's a scam, and that we're all idiots for believing it. And I think it's funny because if you look at the statistics, people are watching these videos. And they don't feel the same way that these commenters do. But for some reason, they feel the need to try to bring others down to their pessimistic view. We believe in the Pi network. And speaking only for myself, I don't care how the Pi coin is performing on the markets. At one point, Bitcoin was laughed at too and was virtually worthless. You have to start somewhere. Now, my message to you commenters who feel this burning need to post off-topic comments, you're talking to the wrong audience, and your comments are effectively graffiti on the walls. Here's an idea. Make your own content. Explain to people why pi is garbage, why it's going to zero, why it's a scam, right? Open yourself up to criticism rather than criticizing others. Several people have commented on comments going missing or being deleted. And I just want to address that. First off, it's my channel. I reserve the right to delete any comments I feel are inappropriate. But in general, I do not delete comments. I leave all these comments that say pi is a scam, pi is going to zero, because it's just noise. But what I will delete is any comment that has offensive language. I don't want it on my channel. So if I see it, I'll delete it. Name calling, calling people stupid or idiots or morons, won't be tolerated. This should be a safe space where people can come and not be subjected to vitriol and harassment. So before I get into today's topic, I just want to go over some of the metrics. So if we look at the Blockchain Explorer, the current circulating supply is 6.763 billion, and that is no change from the past 3 days. The locked migrations are down 1.223 million, and the unlocked migrations are up 1.223 million. So as you can see, once again, the locked migrations are down because they've become unlocked. And now we have 1.223 million more Pi coins that can be traded on the open markets. And as a result, the price continues to fall. Now let's take a look at the volume and price. The Pi coin is currently trading at 81 cents with a market cap of 5.49 billion. And a volume of 290.2 million, which is an increase of 50% from 24 hours ago. Today, I wanted to talk about trading bots. There are quite a few of you that bought and sold Pi on the exchanges, and that's fine. It's your coin. You're free to do with it what you want. But I do want to talk about how the exchanges work against you, especially with crypto. And this is thanks to trading bots, largely. It's like gambling at a casino. A few will win, most will lose, and the house always comes out ahead. Trading bots are automated agents that run within the exchanges. And they watch price action. And more importantly, they watch the placed orders. And this is used to manipulate price, causing liquidation of unsuspecting traders so the whales and the markets can cash in. So how do bots manipulate price action on exchanges? Well, there's a lot of different ways they can do it. And as I mentioned, they use the order books to get a sense for what people are buying, what people are selling, and what your intentions are, because orders placed on the books don't always happen immediately. So there's time for these bots to react and cause events that favor them. One method that bots will affect price is through what's known as spoofing. And these are fake orders that place large buy or sell orders without the intention of executing. As I mentioned, orders that are placed on the books are not necessarily instant. You can put them up there, and if people are watching, what that can do is it affects the price. And this creates a false market sentiment. For example, a bot could place a massive buy wall to make it look like there's huge demands. Based on this, other traders will buy in, pumping up the price. And now these are human buyers, and they don't know this is happening. Then the bot cancels the fake orders and sells at the top. And the reverse can happen as well, where the bot places a huge sell wall to trigger panic selling, and then the bot buys the dip when everybody sells their tokens. Wash trading is when a bot buys and sells the same asset back and forth between separate accounts that it controls. And the purpose of this is to inflate volume and create an illusion of demand or liquidity and attract real traders. And this can cause a price to artificially rise or stay stable, giving a false sense of market activity. One method of order book manipulation is strategic layering, where bots will place many small orders at various price levels above or below the current price. This can anchor the price at a certain level and make it hard to break key resistance or support levels. And they influence technical traders who base decisions on order book depth. Now, this has come up a bit. People point out how the order book depth for longs versus shorts is like 3 times higher with Pi. And I don't see that as a good thing, because that looks like the hallmark of bot trading. And I wouldn't fall for that. So people are using this to predict things like a large rally. And what this does is this affects how people place their orders. When that doesn't happen or the price falls, the bots are just going to scoop it up at a bargain price. Front running is another technique where bots monitor the order book for large upcoming trades and then jump ahead in line by placing their own buy and sell orders. For example, a crypto whale could place a big market buy order. The bot will detect this and buy it first. The price jumps, and then the bot sells at a profit. Ping-ponging is where bots place rapid, alternating buy-sell orders between small price gaps. And what this does is it creates volatility to shake out weak hands. And it does this by triggering stop-loss orders set by human traders. Now, if you don't know what a stop-loss is, oftentimes when you're making trades, you want to control how much you have the potential to lose, because you don't want to lose everything if your gamble is wrong. So you set a stop loss, and you can guess at what stop losses are based on the established resistance levels that are seen historically over the course of an hour or a day or a week, and use that to liquidate these traders. And this lets the bot scoop up assets at lower prices once the volatility subsides. Price pegging or pinning. This is where bots use a cluster of buy-sell orders to keep the price within a tight range. And this is useful if somebody wants to accumulate silently. In other words, they want to buy low without causing the price to pump, and suppress volatility during sensitive events like exchange listings or token unlocks. This one's not particularly nefarious. Depending on how it's used, could be a good thing. People who use this, if you're doing high volume with these low swings, can make some decent money, but for the most part, you're not going to make a lot of money. And keeping a stock price stable is not necessarily a bad thing, depending on what you're trying to do. If you're watching the charts and you see repeating buy-sell walls that vanish quickly, high volume with no real price movement, and orders constantly appearing just above or below your own, you're probably watching bots at work. I've definitely seen the middle case where you see a high volume with no real price movement. Some days you'll see on CoinMarketCap that the volume will go up to 70% over a 24-hour period, and there's no apparent reason for it. In some cases, there's no news to justify it, and the amount of coin that's passing hands hasn't increased. This is clearly a bot at work. Now, you might ask, how is this legal? Well, the answer to that is it depends. If you're doing traditional finance with stock markets, most of this is not legal. But for crypto exchanges, that is not the case. It is largely unregulated. Some of the larger exchanges have policies against these types of things, and they could lead to your account being banned or having you being reported to authorities. However, enforcement is often inconsistent, and in the meantime, you benefit from these practices. So let's take a look at these different bot trading techniques and how they stack up from a legal perspective with traditional stocks. Spoofing is illegal with traditional stocks, but on crypto exchanges, it happens often and is rarely punished. Wash trading is illegal, but it's rampant on some exchanges. Front running is illegal for stock trading, but it is common on decentralized exchanges. Pump and dump. This is illegal, but happens a lot with exchanges, especially with low liquidity tokens. Order book layering. This one is a gray area because there's nothing inherently wrong with it, as long as this activity is not being done to mislead the trading community. Could be hard to prove. If it gets the attention of the SEC, you could have some difficulties. But it is a common manipulation tactic on crypto exchanges. Ping pong trading. This isn't expressly forbidden, but it is regulated with standard stock markets to maintain market fairness. And on crypto exchanges, it's largely not regulated and very easy to accomplish with bots. Why might this be so common on crypto exchanges when most of it is illegal or at least questionable on traditional stock markets? Many exchanges profit from high volume, so wash trading and bot activity actually benefits them. And there's always the possibility, and maybe even likelihood, that they're part of it. Crypto trading lacks global regulation. Even if the US bans a certain activity, an exchange in another country might not care or turn a blind eye to it. And we see that right now. In the US, for example, we've historically been somewhat crypto hostile. And we've seen a lot of exchanges stop doing business in the US because of prohibitive regulations. And that is changing. With the new administration, they're much more crypto friendly, and the landscape is changing with regards to crypto in general. The bottom line is, if you're a trader, assume the market is not fair, because it's not, especially with small cap tokens or on sketchy exchanges. Exchanges love their meme coins. Why? Because there's lots of them, they're cheap, and you can really make a lot of money on the volume. And there's so much room for manipulation that if you have deep pockets, you can make a lot of money by manipulating price. So that's all I have. I am not against crypto trading. If that's what you choose to do, great. It can be exciting, especially when you're winning, but it can be devastating when you lose. I've had my stint with crypto trading on the markets, and it's not for me. I quickly realized that I was being outplayed, and it was clear that the speed and volume in which changes can happen was a clear indication that there was automation at work, and they were using information that is not easily digestible by humans in real time to game the system. Crypto trading is gambling. Like gambling, it can be exciting, and also like gambling, the house always wins. So if you have crypto on the exchanges, that's fine. If you're thinking about it, keep this in mind and make an informed decision. And remember, the success of Pi Network begins with you. Pi to the moon. Peace.